Well, despite the recent underperformance of international stocks versus U.S. stocks, some investors are positioning for a reversion to the mean and a performance leadership change. When will it arrive, and will you be ready? Well, today's audience-requested ETF matchup features a head-to-head contest between international equity dividend ETFs from Schwab and Vanguard. So who wins the battle? Find out right after this. You're watching ETF Battles. I'm Ron DeLegge. This is season 5, and I'm glad to have all of you with us. I hope your 2024 is going well. If there's a certain ETF battle you'd like to see, send me your ETF ticker symbols in the comment section below or on our X feed at ETF Guide. Also, don't forget to visit the description section below. We've got program links to our judges as well as our program sponsor direction, along with viewer resources. Today's audience-requested ETF battles from Mario Green, and it's between international dividend ETFs from Schwab and Vanguard. It's SCHY going up against VYMI. Again, VYMI. Thank you, Mario, for that excellent ETF suggestion. Helping us to sort through the clutter is James Seyffart with Bloomberg Intelligence and Tony Dong, the lead ETF analyst at ETF Central. Guys, great to have both of you back.
Great to be back, Ron.
Yeah, happy to be back, Ron. Thanks again.
So we're going to go through our 4 battle categories, give each one of you an opportunity to weigh in. Keep in mind that our judges can also, for the mystery battle category, pick a factor that they feel is important. It's a mystery, meaning we don't know what it's going to be until they tell us. And then also, none of the battle outcomes on this program are ever known in advance by myself or our judges, or are they predetermined? So let's kick things off with the first category, cost. Tony, please get us started.
Okay, so it's pretty clear-cut here. VYMI charges 22 basis points. It's pretty high up there, but not atypical for international ETFs. SCHY significantly cheaper at 14 basis points, 8 basis points cheaper on $10,000. You're paying about $14 in fees a year. So my vote here goes to SCHY.
Thank you, Tony. James, you're up next. How do you see it when it comes to cost?
Yeah, if I'm looking at cost, there's no argument with anything Tony just said. I mean, they're both relatively cheap. They're under 25 bips. As he said, you can get a little more expensive when you start looking at international stocks and holdings, particularly ones that are a little more active than just the pure beta exposure. But still, 22 bips is a little high for this, as far as I'm concerned. Even 14 bips isn't all that cheap, considering we have 3 bip and 2 bip things and 0 fee ETFs here investing in U.S. stocks. But yeah, SCHY, clear winner here at 14 basis points.
Exposure strategy is next. And James, you're still up, so give us your take.
Yeah, I mean, both of these are trying to go after international dividend stocks. So the name is the same, but they have kind of different exposures. I mean, the one thing that I'm looking at here is if you look at the number of holdings that it has, VYMI is way more diversified. So if that's something you are after and you're after a diversified portfolio exposure, I have VYMI at over 1,300 holdings, whereas SCHY is 131 holdings. So 131 holdings is still relatively diversified, but you're way more diversified in something like VYMI than you are in SCHY. And also, but then again, you have more idiosyncratic risk because the top 10 holdings in SCHY make up like 41% of the entire portfolio. So this is a relatively high concentrated bet if you're going SCHY. But again, they're high dividend. They're a little more stable than some of the more high flying stocks that a lot of people tend to talk about. Still, my winner here is VYMI because it has a little bit more diversification in the exposure that it's offering.
Tony, you're up next. How do you see it when it comes to exposure strategy?
I'm going to pick SCHY simply because I really don't like what VYMI's index does. So it takes the FTSE World All Cap ex-US index, it removes real estate investment trusts, and it removes stocks that are forecasted to pay no dividends. And then, this is the part I really don't like, the remaining stocks are ranked by their forecasted annual dividend yields until the cumulative market cap of the portfolio reaches 50% of the overall universe. To me, that just sounds fairly arbitrary, and the cutoff there doesn't really make a lot of sense. On the other hand, SCHY's index is far more meticulous. It excludes real estate investment trusts, and then it also looks at 3 things: 10 consecutive years of dividend payments, liquidity requirements for floats, and also it screens it on 4 fundamental metrics: free cash flow to total debt, return on equity, and a 5-year dividend growth rate, which they use to create a composite score to find the final 100 sorted by volatility less than the median. Now, it's fairly elaborate, but given the fact that it's cheaper, I'd say that you're getting more bang for your buck with this index here. And for the readers who are familiar with SCHD, which is its US counterpart, this is literally the same index that SCHD uses. So my vote goes to SCHY.
Performance and yield is next. Thank you, Tony. And you're still up. So give us your analysis in this particular category, Tony.
So SCHY really hasn't been around for a long time. Historically, VYMI has outperformed it in case of total returns, which is what I was always look at. In terms of yield, I'm looking at trailing 12-month yields. SCHY is sitting at around 3.6 right now, and VYMI is sitting at 4.45. So both in terms of total returns and yield, historically, of course, VYMI has outperformed even after accounting for its higher fees.
Thank you, Tony. You're up next, James. How do you see it in performance and yield?
Yeah, SCHD is a powerhouse ticker, and they're just porting that strategy over to SCHY. So I love what Tony just pointed out there. That said, I'm looking at 12-month yield, and I see the same thing. I see VYMI as having a decently higher 12-month yield than SCHY does. And also, when you look at performance, I talked about SCHY just copying SCHD. That thing only began trading in 2021, so we don't have a ton of history to look at. That said, since SCHY has existed, like Tony said, VYMI is the winner here on performance and on yield.
That takes us next to our mystery battle category. James, you're up. What is your mystery battle category, and which of these two ETFs wins it?
Yeah, so when I look at this, one of the things that I thought was the big differentiator here, as far as I'm concerned, which doesn't make that much difference, but it's liquidity and trading. The spreads and the bid-ask spreads that we have in SCHY are significantly wider than VYMI. So for anyone who's trading ETFs, pretty much always use a limit order. That's a guaranteed thing, but it definitely would matter more in this case because SCHY has higher bid-ask spread percentages, and also the trading volume is significantly lower. So we're looking at average daily volume of like 25.5 million in VYMI as far as I'm seeing this, and just 3.3 million in SCHY, which isn't nothing. Like, you'll be fine if you put a limit order, though the market makers will be able to execute. But if you're just looking for safety and more liquidity or a larger investment, VYMI wins out here. And part of this is probably because what I just spoke about, SCHY is a relatively new ETF, so it hasn't built up that level of liquidity that we're used to seeing with older products. So my winner here is VYMI based on its liquidity profile.
Thank you, James. Tony, you're up next. How do you see it in terms of your mystery battle category? Give us your analysis.
My category is turnover rate. This isn't really something people notice, but I think it actually plays a fairly big role in not only tax efficiency, but also tracking error. SCHY's index is very stringent, and as a result, the turnover is quite significant for a supposed index ETF. It sits at around 39.74 right now. VYMI, because its universe is far broader and its index is less stringent, the portfolio turnover is only at 16%. So all else being equal, I'm going to give it to VYMI here simply because I think the objective of choosing an ETF like this is to minimize regrets, right? With VYMI, you're getting more stocks. It might be more expensive, but at least you have some assurance that the portfolio is very diversified. Whereas SCHY is more of a swing for the fences. You got to really believe in what it's doing to hold it comfortably.
All right. I got you down for VYMI. Thank you, Tony. That brings us to the final part of our show where our judges can give us their overall winner. And Tony, you're up, so give it to us.
It's going to be VYMI. As much as I like how SCHY is cheaper, and I personally like the robust index methodology uses, I do recognize that for the vast majority of passive investors or maybe new investors trying to add an international holding, it's going to scare a lot of people. VYMI offers all the right things. The fee might be higher, but you have a very robust portfolio that's fairly distributed between sectors. You have an index that's very easy to understand and follow. The turnover is low, and the dividend yield is quite attractive if that's what you're looking for. So there's a reason why this Vanguard fund is fairly big, and that's what I'm going to go with.
Thank you, Tony. James, your final chance to weigh in with your overall battle winner. Give it to us.
Yeah, my winner's going to be VYMI as well. I like the fact that it's a little more history. It's ironic, though, that Vanguard is losing in the fee category in a few other areas and winning on the trading volume category in an ETF battle. So you don't see that too often. But yeah, I like VYMI because of the diversification factors. If there is something you like in the specific way that SCHY is running their portfolio, like Tony said, it's going to be a little more concentrated. But if you're just looking for a dividend exposed international ETF, you're going to get way more diversification in VYMI. And also, based on the portfolio that I'm looking at, it has much lower price to equity and price to book ratio. So the value factor is a little bit more there on that front too, if that's something you're interested in. But yeah, overall, I like VYMI based more than I like SCHY, but both are fine products. They're just, you got to know exactly what you're looking at, and one might fit what you're looking for better than the other. But I'm picking VYMI as my overall winner.
Well, our judges have spoken, and according to my battle scorecard, today's winner is VYMI. And I thought early on in this particular battle that it was going to be SCHY that comes away with the victory. It started off strong, but it didn't end strong. And as our judges pointed out, VYMI, of course, has a longer history, also a slightly higher yield. It's more diversified, too, which was really a key takeaway. I mean, you got 1,300 stocks in VYMI versus just 131 in SCHY. So significantly different portfolios. VYMI, of course, much more diversified in terms of actual holdings. Our judges like that. And our judges agreed across the board for the most part on VYMI. And great job to you guys, James and Tony, for breaking it down. We couldn't have done it without you.
Thanks, Ron.
Yeah, thank you, Ron. This one was fun.
Well, thanks again to James and Tony for breaking it down for us. Be sure to visit the description section below. We've got links to our judges. We've also got links to our program sponsor, Direction. And which ETF battle would you like to see? Hit me up in the comment section below with your ETF tickers or on our X feed at ETF Guide. I'm Ron DeLegge. Thanks for watching ETF Battles. We'll see you on the next episode.